Good day, everybody, and welcome to our short course on asbestos bodily injury claims and specialty risk transfer solutions. This is actually one in a series of short courses we'll be providing over the coming days to you. These short courses are designed specifically to be very focused on relevant topics that occur in your everyday business lives, and they're also meant to be very brief, basically 15 to 20 minutes or so you can come in, get a lot of great information fast, and then back to your busy workday. So with that, let's go to the next slide. So what are we going to cover today? We'll talk a little bit about the background on third-party bodily injury claims, what the asbestos challenge is for folks who have third-party claims. We'll talk about actuarial analysis, the fact that regardless of what we know in actuary, that it's still a frictional cost. We'll then go into risk transfer solutions that are available, those underwriting needs. We have a great case study, and then we'll talk about applications. So with that, let's begin. So as background, our panelists today, I'm Jim Vetter. I'm a managing director within the environmental practice. I specialize in mergers and acquisitions and complex risks. Kim?
Kim Mann, also in the national environmental practice with a heavy focus on complex risk transactional business. Thanks, Jim.
Next slide. So why are we here talking today? The bottom line is a lot of industries in North America are subject to third-party claims for bodily injury related to asbestos. We can all think back to when we're watching TV and the asbestosis and mesothelioma advertisements come up. And the bottom line is, again, a lot of people are subject to this possible risk because if we look at how asbestos was used historically in North America, it comes up in three different situations. There were companies who had a history of actually manufacturing asbestos-related products. Then there were companies who were just merely distributors. They were basically intermediaries between the manufacturer and end users. Then there were a host of other companies that were involved in the installation of asbestos products. So we think of, typically boilers as being the classic example. So as you can see, if we really think through that whole life cycle, a lot of people touched asbestos-containing products. And how they come up in your business world is a couple ways. There's still businesses that are subject and have these type of liabilities because they're still distributing or installing, or more importantly, in a lot of cases, actually removing asbestos-related products. More commonly, it's related to past operations. So you may not be doing it today, but a business that you either have now or maybe inherited was doing these type of things in the past. More commonly, we see it come up in mergers and acquisitions where two companies are coming together and, the acquiring company just happened to have an asbestos history that now suddenly has to be dealt with. So again, a lot of different industries and a lot of different circumstances that can give rise to these claims having to be dealt with. Next slide. So what's the challenge with asbestos claims? The bottom line, it's really about forecasting and managing what we believe the future costs are going to be. So we may have a good sense of today, the number of claims that are in. We may even have a sense of what's been in the past in terms of claims. The real question is, what's the future look like? So how are these claims going to develop over time? And the two factors are really what's the number of claims, and then from a cost perspective, how do those individual claims play out individually and in the aggregate? So as we look forward into the future, the big question is, where does this go? Next slide. The usual way it's dealt with is through actuarial analysis. So a lot of companies will basically hire experts who can come in and, based upon a number of factors, project where we think it's going to lead in the future. So, actuaries will typically take a look at things like what's the exposure. So what were the products that were either manufactured or distributed or handled? What was the market share? How long were things, actually being dealt with? So the exposure is one thing. They'll also look at claim development. What are the claims we have today? More importantly, what were the claims that we had in the past, and both in numbers and payout? And that begins to allow us to project into the future. And then the other thing is basically also insurance, because there may be circumstances where different liability policies may actually be paying out in some circumstances and helping to offset that claim development. So all three of these things kind of come together to allow a picture to be developed on where we think the future will be. Next slide. And this basically articulates it. So if you look at a typical asbestos actuarial output, what they do is they'll actually forecast projections into the future, on percentiles between the 45th and 95th, and usually every 5% in between. So now instead of having an unknown in the future, we now at least have some bounds around what we think will be the likely outcome of future claims and how that can impact the business. Next slide. But still, regardless of how well we think it's going to develop, couple things. This is still a frictional cost. You still have to devote a significant amount of management time, resources, and salaries to manage these claims. And the other thing is we may have a range in likely outcomes, but the question is, where's it going to fall? Is it going to be that 45th or the 95th percentile? And suddenly, if we underestimate, it's still going to be a drain on metrics away from valuable business investment. So again, like these things are things that, are not part of your core business and are quite a headache. Next slide. So what can be done? And this is a transition slide over to Kim. The good news is, regardless of what you may be dealing with, there are solutions to make this pain go away. And the two solutions are basically adverse development cap, where you retain risk, but above a certain point, insurers will cover cost overruns. And there's also loss portfolio transfer, which is literally $1 transfer these liabilities off the balance sheet. And with that, I'll turn it over to Kim and she can go into more detail. Kim?
Thanks, Jim. So two main solutions we're going to talk about today. So the first is the adverse development cap, which is an insurance product. So essentially it's an insurance solution where you're looking at the attachment, which is really built around the forecasting done from your actuarial. So where do we think this is going to be? And that helps us establish an attachment or a self-insured retention. So anything under that attachment, you're going to keep. It's going to be business as usual. So all of the costs and expenses underneath that self-insured retention attachment point, that's going to be yours. All of the use of the old general liability policies, umbrella, excess, any policies that are going to potentially respond to asbestos claims, those are going to stay within your purview, and you're going to continue to seek contribution from those around the claims. Again, business as usual. The defense, the management of those claims, they all stay yours. But really what this cap does is, at that attachment level, if there really is adverse development for any number of factors, as Jim's talked about, that go up and above the attachment level, that's where the insurance steps in and provides you with additional risk transfer above that cap. So this product is really powerful because there's no policy term. So once the premium is paid to the insurer, those limits are going to be in place until such time that they're eroded. So if you do have a lot of development that moves up and into that insurance layer, that cat loss situation, this policy is going to step in there. So what's the cost of it? This is an insurance product. And so you're going to pay an insurance premium. So you're going to pay a rate online based on the amount of limits that you buy above the insurance cap. Let's move to the next slide. So loss portfolio transfer has a similar premise as far as providing coverage for your overrun, but the main difference is this is going to step in at $1 rather than an attachment point. So it's $1 response up through forecasting and then up to whatever limit you buy to protect yourself from overruns. So from an application perspective, here, the insurance company is going to take the responsibility. So they're going to take all the costs starting at $1. They're going to take over the use of your historic general liability umbrella excess policies. They're going to seek those contribution from those insurers, and they're going to manage that process just as if they were you stepping into your shoes. They're going to handle the defense and they're going to handle the management. And so really, again, similar concept to the cap, except for here, you transfer all of that admin and costs to them. They step into your shoes, and the policy that's put in place comes in and is $1 up through whatever limit that you ultimately purchase, protecting you from overrun as well. So same situation, no policy term on this solution. So you're going to, in exchange for cash up front, purchase a program, $1, all of the admin and management up to the time the limits erode, that policy is going to be in place. So from a cost perspective, this is going to be a little bit different and a little bit heavier because you're going to be paying and pre-funding essentially all of the existing forecasted claims up through the insurance premium for the overrun. So let's move to the next slide. How do we go about this process? And it's really similar for both the cap and the loss portfolio transfer. And it starts with your actuary. So understanding what's the number, what's being forecast, what are we expecting from a dollar figure and timing perspective. And then moving into what's the exposure. So what's the history of the product or premises liability? Where have we seen the claims come in? So similar to any underwriting on insurance that you're probably used to, kind of what's the exposure and what's been the loss history and performance, and that makes up your total underwriting basis. So what are the claims that we've seen from a history perspective? What are the disease types? Is it mostly mesothelioma? Do you have a history of lung cancer? Is there secondary exposure based on your specific situation? Then looking at legal. So what's been the legal performance? Have you been using panel counsel? Have you been paying up and above panel counsel? What's been the legal defense strategy? Again, understanding kind of what's been done historically for a new underwriter to understand. Jurisdictions, where are we seeing these claims? Are we seeing them go through kind of high flow areas that are very used to asbestos claims? Are they in less favorable jurisdictions where there's a lot more uncertainty? Have you seen a lot of batch claims that have all been closed out, or are a lot of those claims with merit and expecting to see payment? How have you managed the claims? Are they in-house management? Are you using a firm? Again, looking backwards to see what's happened to understand, and kind of pair with the actuarial and economic projections of what's going forward. Last piece here, section 3, your first line of defense is going to be what historical insurance assets have you already purchased and you already have access to that are pre-asbestos exclusion. So are those policies responding 100% or are they only partial? And are you contributing in some co-insurance type fashion? Why is that the case? Is there defense outside of the limit? So if a lot of the risk is around defending to get out of claims as opposed to actual indemnity, how does that defense outside the limit or defense within the limit erode the policies and again, potentially prolong the life of those assets? Do you have exposure post asbestos exclusion? So all these policies are only going to respond to claims alleging exposure prior to any exclusion being implemented on the policy. So is there exposure that really any of these historical assets aren't going to respond to? Just understanding that situation. And then again, very simply, what limits are left? So how much protection from a first line defense perspective do we have? If you don't have access to all of these policies, there are archaeology services that'll help you identify those, because this again really is a core piece, not just for, do we want to look at solutions, but a core piece of what do you already have access to that you might not be utilizing and helping protect your own balance sheet. So let's go ahead and talk through an example. So here we have a target company who is a distributor of industrial products, distributing many products, but one of them was asbestos containing. And so because of that nature, they weren't manufacturing, they weren't installing, very middleman type of a situation, didn't have a lot of claims experience and very, very minimal payouts, which, is certainly a good thing, except for it makes it very hard to project and understand how future development could arise. And so in this situation, we were working with a private equity firm who was in due diligence to acquire this distributor. And asbestos was really a big sticking point as to whether they could get comfortable to make a bid and go forward. The risk committee really was not comfortable taking an uncapped asbestos risk onto the firm. And so, what happened is they came to Marsh and we helped them understand and put together a solution for the asbestos on this target company. So the first thing that we did was we really helped them locate some additional policies from a historical perspective that would respond. So in the due diligence, they had only been provided about $2 million of remaining GL, which is very minimal. And we helped them identify 4 additional umbrella policies that increased that historical insurance asset up to 22 million. So again, very meaningful and a key step here. So with that and our actuary study and all of the information that we had on the target company, we went ahead and engaged the adverse development cap marketplace and worked to develop a solution for them. So this was a really unique situation, again, because very minimal claims history, a decent amount of historical insurance assets now that would apply. We were able to put together really almost a hybrid of an ADC and a loss portfolio transfer, because this solution that we orchestrated had no self-insured retention. So it would drop down to $1 to respond to claims that didn't trigger historical assets, but wrap around any of those historical assets of the $22 million of prior policies that would respond first in the event that they were triggered. So reminder, this type of a solution has no policy term, which is really especially valuable in a private equity setting where the investment horizon typically would have them ultimately selling this business down the road. So these type of policies have no term, but also have the ability to be reassigned in the future. So not only making this solution a key part of this current transaction, but also from a long-term perspective, a possibility to really help them with the business down the road. So we put together this program up to $100 million of total risk transfer, giving the investment committee the comfort level that the asbestos liability was indeed capped and their fund was not exposed. Premium, $14 million, which is certainly a significant amount. However, in a transactional setting, they were able to build that $14 million of premium into their bid, take the asbestos liability, knowing that they had this protection, and then that enabled them to actually go ahead and win the bid. It was a very competitive situation. So this was a huge win for our client in their business getting this deal done, and this was a solution that enabled them to get there. So one question I do get a lot is, what's the size of the company, or what amount of asbestos liability is needed for these solutions to apply? And the answer is there's really no magic number, because it all depends on the players and the motivations around how this asbestos liability is impacting the business and what you want to do about it. So I think this case study is a great example of a pretty minor asbestos exposure, however, a solution that enabled business to move forward. So I'm going to move to the next slide. So who is this for? Answer is anyone who wants the pain on asbestos liability claims to end. So you can look at this on corporate liabilities if you want to cap or transfer in order to ultimately improve your 10K and your reserving process or the administration. You can also look at it in a transactional situation. So M&A, like our case study, but also you can look at it in spin outs and bankruptcy deals, corporate restructuring, any situation where the asbestos liabilities are impacting financials or a deal. This is a solution and an option that could potentially help you support your business. So with that, I'm going to turn it back to Jim so he can close out today's short course.
Thanks, Kim. And thank you to everyone for joining us today. Hopefully you've gained a lot of very useful information that will help you in your day-to-day if asbestos liabilities come up. Hopefully you will join us for future short courses. The topics will include counterparty credit risk, cost cap, and the M&A toolbox. So with that, thank you again, and we'll look forward to hearing from you if you have any questions. Good day.